a great quote that I love, and it goes like this. I forget who said it, but someone much wiser than I. And the quote is basically that if you are selecting individual stocks without any idea of what you're doing, then it's kind of like running through a dynamite factory with a burning match. You may live, but you're still an idiot. And my point is, don't be an idiot. If you're going to start doing the investing on the side, and you need to really, figure out how the world works, and I think that's part of figuring out your own investment philosophy. But my point to you is have a strategy before you go into it. Otherwise, it's just going to be frustrating, and you're probably going to lose a lot of money. The strategy that I'm going to talk about, again, is value investing. And from a high level, this is greatly simplified for a couple reasons, one of which is just so I could put it all in one slide. But I think there's, in general, probably three ways to invest, three approaches to investing itself. I tried to lay them out as simply as I could, and again, this is very simplified. But to be clear, what I'm talking about, what I'm doing is over on the left. That is the long-term fundamental value investing, and we're trying to identify gaps in the market. Differences, between what the real value, of a company is and what the market seems to think it's worth. There's another strategy or another approach that's much more short-term and focused. There are some fundamental, and does everybody know what I mean by fundamental approaches? A fundamental approach is one that's very quantitative. You're looking at the financials, you're reviewing everything, you're putting valuations together, so it's very much focused on the numbers rather than anything else, and really getting a thorough grasp on everything that's involved. There are short-term investors who do similar work as value investors do, but they're not necessarily comparing differences in price levels as much as they are trying to predict when the next change might be, whether that's a change in earnings, something that in the short term might spark a interest in the stock for a handful of reasons. There are short-term folks on the technical side, and I worked for a technical boss for a few years, and it just never took. It's just a different way to think about the market. You're very much approaching the market, and I don't mean this in a derogatory way, but as if stocks were just pieces of paper that happen to change hands a lot across the river. And that number one approach over there is very distinct from that. But under this would be your typical traders, your momentum guys, people focus on price volume more than the fundamentals of a company, and even charting, folks who will, it seems like shaking chicken bones sometimes to me, but who will look at the chart, be able to say this is the head and shoulders pattern, or this is a reverse teacup coming, and somebody had a good quote that if you actually take the chart and turn it upside down and the guy tells you the same thing, then that's how you know the chart is full of BS. I'm not sure it actually works. Well, I think studies have shown that it does work in a very small set of circumstances, but the reality is the trading costs associated with it for the guys who really do know what they're doing makes it basically pointless to try to do. Be librarians, yes, exactly. Yep. If past history was all there was to the game, then yeah, librarians would be running the world. The third approach is, and this is one more in academia. This is the efficient market approach. When I went to business school a dozen years ago, the efficient market approach was how we were taught finance. And candidly, I really wasn't interested in much of this stuff and investing in finance in general, even though I was in business school, because the first class I remember having was basically the market's efficient, don't try to beat it, and let's do some differential equations and I'll try to prove why. And that wasn't at all to me what investing seemed like it should be about. And it was in fact trying to slog my way through that efficient market theory stuff one night a dozen years ago that I stumbled across an article about Buffett, read that, and something just sort of clicked. This guy has clearly got something more intuitive going on, and if the efficient market were true, well, how do you explain this guy? How do you explain this guy in Omaha who's beating the market hand over fist and not subscribing to any of this? Not to totally disparage the efficient market idea. I think in the long term that is correct. In the long term, markets are efficient. Prices generally converge towards values across asset classes, whether you're talking bonds, stocks, anything else, commodities even. But I think it's a mistake to presume that the market is 100% efficient all the time, every day. And if nothing else, I think the credit crisis we just went through probably underscores that a little bit. So It is an index-driven approach to investing. It's focused a lot more on asset allocation. And candidly, there can be a place for that, I think, when you're trying to, for instance, protect wealth rather than really grow it. There can be a lot more validity to that than I'm currently assigning to it, just because, candidly, in a different place in a lot of ways. Value investing. There are academic studies that will show that by buying a basket of low price to book stocks over time, value investing will outperform even the market. There's 3 or 4 good studies. French Pharma is one of them. There's an LSV, Lashinick, I don't even remember their names, but there are academic studies that lend some credence to the whole idea behind value investing. Independent of that, though, I think, in my head, the empirical evidence that is Warren Buffett, that I think gives a lot of credence to the approach, more so than anything else. Usually either 1 or 2 on the list of the Forbes 500, has a net worth of $50 billion. And unlike a lot of people on the Forbes 500 list, his was really driven through investing. Now he parlayed that, kept buying bigger and bigger things, and eventually had the company around him and made it easier. But he is unique on that list of world's richest people in that he really took a stock market investment-driven approach to doing it, rather than, for instance, inheriting wealth, rather than starting a company like Microsoft and having it all accrue to you through the whole process. So, and this is his quote. I won't read that to you. You guys can read that just as well as I can. But there are 4 things there that really drive the heart of value investing. I don't know that we or the world really needs a lot more wisdom in it than that in terms of investing. I think there's a constant search for the next new investing fad, how to beat the market X, Y, and Z, and my belief is that we don't necessarily need that because Buffett is there. And his intellectual heir, if you will, the father of value investing is a gentleman named Ben Graham. Between Graham and Buffett, I tend to think that we investors have probably got the roadmap already there. It's just a matter of whether or not we're going to pay attention to it or try to do other things. One of the other things I love about Buffett is that he's got a quote for just about everything. We're going to ratchet. He's just been around so long and has written so many great shareholder letters over the years that if you ever need an opinion or waver on what to do in investing, odds are if you Google Buffett and that topic, you'll find something along those lines. And it's a lot of folksy wisdom. That's part of the attraction to him. But I did want to hit on, I guess, 5 or 6 of his key points, the framework of value investing before we get into the case study. So valuing a business, as Buffett himself says, the critical part of value investing, and I shouldn't even try to quantify it like that or qualify it, there really is no distinction between value investing and growth investing at the end of the day. It's all sort of 2 sides of the same coin, as Buffett says. The key is to be able to do the valuation and figure out what a company is really worth and compare it to what the market thinks it's worth. In the long run, those values will probably be close, but in the short run, there can be discrepancies, and you can take advantage of them. One of his other principles, if you will, is the idea of a circle of confidence, of not straying too far out of the things that deep in your heart of hearts you know enough about this industry or about this company that you're confident in investing in it. I think, if nothing else, if investors would stay more within the circle of competence, it would just alleviate a lot of problems that people have. And yep, go ahead.
I like saying that when you're approaching a perimeter and you leave that perimeter circle of competence, you're more into a speculative realm.
Exactly. Yes. Yep. Yep. And that can bite you very easily when it comes to investing. The stock market is the most competitive thing really in the world, most competitive of all activities. There are tons and tons of very smart people. I am by no means the best analyst that I know. I'm by no means the smartest guy I know who runs a fund. I think if there's a difference, it's just a way that I view the world a little bit differently, and that seems to hold up. What Buffett is saying, though, is you've got to be honest with yourself. I'll give you an example. Last year around this time, I was looking hard at JP Morgan, considering them, investing in them for a target portfolio, just because clearly they're going to have a little rough road ahead, as all the big banks would, but they were going to be a survivor. Their position was going to be strengthened. But if you look at JP Morgan's balance sheet, it's not even all on the balance sheet, but they have about $77 billion in derivatives somewhere on their books. I don't think they really know what that is. I certainly don't know what that is. And by staying within my circle of competence, ended up passing on JP Morgan. You can argue whether that's a good decision or not. Surely the stock has gone up since then. But that's the point I'm trying to underscore, is I try not to reach far out from the things that I think I know. One of the other key parts of Buffett's philosophy is the idea of moats. A moat being a durable competitive advantage. This is not Buffett's list, this is sort of my own, but in terms of the laws of capitalism, I think this just makes a lot of intuitive sense. What you want to own, if you're a long-term investor and you're sensitive to the value, which I'd like to encourage you to be, is a business that can defend itself from other businesses. The way capitalism works is that once other companies or even other potential founders of companies see the economic benefits, outsized economic benefits, accruing to one particular company in particular, what do? Start another company, start another business, because if they can reach those benefits, then we can start up something similar and do the same thing. The only thing that's going to protect you, the investor, and that company from that competition, which is just inherent, it just goes with capitalism, is to be investing in companies that have durable, sustainable competitive advantages, that have moats. So these are a handful of different moats. Again, this is not a Buffett list. This is sort of my own list. In general, there could be some more. There could be some others that people throw in here, but these are ones that I think are the most commonly held moats, durable advantages. Top of the list is being a low-cost producer, and more specifically, being the low-cost producer in a commodity industry will 9 times out of 10 give that firm pricing power. The point of that is that the margins that firm will earn will be higher even though the price they're charging is lower, because their whole cost structure is built in a way that it's less than the competitors. Switching costs is one. These are businesses where it's just a pain in the butt to have, for the customers to have to move. And by the way, one of the companies that we own in Tarpon is a company called Contango Oil and Gas. They are far and away a small company, far and away the lowest cost producer of natural gas in the world. You just can't get natural gas out of the ground any cheaper than Contango can. Does anybody want to try to give me an example of a switching cost? Again, a business built on people just finding it too much of a pain in the butt to actually move their business elsewhere. Yes, sir? Exactly. Yep, great example. There are probably some other advantages that come into play when you talk Microsoft specifically, but switching costs is definitely a high one. Anybody else want to take a guess as to?
Cell phones, or cell phone companies, I should say.
Cell phone companies can be? Yep.
Contracts.
Yep. Anything contractual? Yep. I'm sorry?
Walmart.
Walmart, I think I would put their advantage more in the economies of scale. But to your point, in terms of pricing, yeah, they are the low-cost provider. You could argue a lot of that was driven by economies of scale, specifically local economies of scale. And if you are looking at the local level, then it could be a pain to switch from Walmart if they're the only store in town. So a lot of overlap in a lot of these. Yep. How about, yep, go ahead. It does, and Cisco's got its tentacles in a lot of different things right now. I would say Cisco is not necessarily a long-term switching cost advantage. Other people would disagree with me. Say again? A lot of competitors, yeah. And Cisco's roots, don't forget, were really creating boxes for the internet, if nothing else. In the long run, I think that all of the boxes, all the equipment providers in the telco space specifically, they're all just basically making toasters. At some point, 10 years down the road, the thing's going to be a commodity. It's going to be a toaster, and it's got to be differentiated some way, shape, or form. Cisco does have advantages. I'm not necessarily sure it's long-term switching costs. Could be some short-term costs, but either Juniper's going to come out with another box, Redback will come up with something. So very competitive field, and technology in general, it's hard to get those switching costs, I think, in a lot of cases. Yeah. Economies of scale, everybody I think grasps what that is. Basically, the larger you are, the less it costs you to bring on new customers. You can take advantage of a lot of things, your geography, your reach, and it's basically a lower marginal cost per customer acquisition kind of metric. Excuse me. Intangibles, this would be where I would lump companies like Coca-Cola. There's really, when you step back and think about it, to make brown sugar water should not be that hard. You would think that just about anybody in the world can probably do that, but nobody can. or nobody, at least nobody can really compete with Coca-Cola. I would argue that that intangible, it's not on their balance sheet, but still has a lot to do with their success, is just the brand, just the Coca-Cola brand. It's in everybody's head. That gives them a durable advantage, and will probably continue to do so for yes, yep, great point. Yeah, there's definitely a branding element to it. There may be some of these other elements to Google, but I think the intangibles is a huge one. Yeah, and to that point, anything, FedEx would be another one. Anytime you use the company's name as a verb, and I'm going to go FedEx something, or I got to go Xerox something, that's probably a sign that there's some intangible advantages there that that their competitors just don't have.
Name makes it into the dictionary actually as a verb.
Exactly. Yes. Yeah. Yep. That's a good test. How about on the regulatory side? And by regulatory, I mean industries that have enough rules and regulations there and baked in that it precludes other people from copying their products or doing the same thing. Exactly. Yep. No, utilities are a great example of regulatory advantages. Well, not to say it necessarily makes for a great investment. I mean, the other part of utilities is that the rates they charge customers are also regulated. So just having a moat isn't enough. It's got to be in the context of a lot of things. But to your point, yes, I would say utilities are a very high regulated industry, and that discourages competition simply because you can't start another one up down the street. How about pharmaceutical companies? Does that make some sense? Yeah, nobody's going out and making more Viagra simply because they can't, because Pfizer well, Pfizer is afforded protection by the government. What Pfizer also owns, though, is IP, the intellectual property. In my head, the jury's still out on and how much of a moat can really be held or can really be afforded to intellectual property. And I guess I say this for a handful of reasons, but people in the healthcare industry, for instance, will tell you that it's not really it's not a patent until your first lawsuit. Until you successfully defend your first lawsuit, then it's not really patent. I think there are ways, particularly when it comes to manufacturing, the more stuff we seem to outsource overseas, I think the more and more our IP is probably compromised and not as strong, I guess I would say. Intellectual property, probably fairly strong 10 years ago. I think if you're talking domestic companies, most industries, it still is a reasonable moat. But I put it this way, I wouldn't invest in anything just because it had strong intellectual property. Too much potential for things to go sour there. The last moat I would mention to you, and we'll talk more about this in our example in a few minutes, is network effects. Network effects basically meaning the more people use this particular business or service, the more it excludes competition. The easiest way to talk about this is to talk about eBay. If you want to sell something secondhand out of your closet, where are you going to go? You need to do it online. You're going to go to eBay. Why are you going to eBay? Because everybody uses it, yeah, because that's where all the buyers are. So there are, it's a little bit more rare than some other ones, but my own opinion is they can be more powerful. Those network type effects where the value to the network of an additional person coming onto it and using those services is more than the earnings that accrue to the company. The network is growing faster than the value of the service that's on it. Yes? Yeah, a fax machine. Perfect example of network effects. Once one person has a fax, and once the second person has a fax, once the third person, you can start to see that network blossom and more people start using. So how are you going to compete with eBay? If you step back and think about it. If you're going to start a business today that was going to compete with a company like eBay, whose moat was network effects, well, the only way you're going to do it is to be able to build a network that's bigger than eBay's in order to convince buyers and sellers to come over there. It's not going to happen. Well, I don't think there's any rational venture capitalists in the world who would do that without some serious cost controls in place. Sure.
There were people that actually pressed
Yeah. I guess the litmus test in my mind is in 10 years, is Craigslist going to be bigger than eBay?
No.
They may have a bigger niche. Yeah, and that's the, right.
The problem is you have no...
And if Craigslist were public and we could look at all its financials and compare apples to apples and see which was the better company, well, we'd have a little bit more data. My hunch is that the economics of Craigslist aren't nearly what they are at eBay, simply because eBay is that much bigger, which affords them some of these other advantages like scale and switching costs, that sort of thing. Yeah, no, good point. Let me be clear about this. Most companies that are out there today don't have moats. It's only a small percentage, I wouldn't attempt to quantify, but most companies that you and I know don't have moats. So then you look back and say, well, clearly there's some still pretty good companies. And I would argue that the companies that don't have moats, And if you're going to invest in a company that doesn't have a moat, the thing you need to focus on is how efficient that company is. It all comes down to efficiency, and then you're looking very hard at, if you're talking about grocery stores, you're looking at the turnover, you're looking at the cash conversion cycle, all those sort of metrics, those more efficiency-driven metrics, those may very well come into play more when you're analyzing companies, depending on your future roles. But I think it's safe to say that most companies don't have a competitive advantage, and it's by design that I feel like by focusing on moats, you're able to focus your investment opportunities a lot more. It's one of those sort of screens that that makes a lot of sense to me. So I'm purposely excluding looking at companies that are better than others just because they might be more efficient without a real moat behind them. Sure. Great point. And you're right, I didn't mention it that much. It is a key part of Buffett's investment criteria is you're viewing an investment as becoming partners with those same people, those managers. Are those the sort of people you would really want to partner with in business for 10, 15 years, however long you own the thing? Very key point. I personally, I don't put a lot of credence in talking to management just because I've talked a lot in the past, but I very much believe that management, whether they're competent or not, will very much be in the numbers. They'll very much show up there. And I do check things, management stake. I was just writing to somebody about this recently. Management stake, their salary, all that helps you fill in the picture. And it's more of the art and the science when it comes to investing, is trying to get a gauge on management. Are they owners in their own business? Do they behave? Are they somebody you'd want to work for? Is it somebody that you would want to be partner in a business with, more to the point, for a long time? And management is definitely a key part of things. Yep. Probably economies of scale. It's one that most of the Fortune 500 companies just get to big enough size that they could really crush into competition just by lowering their prices long enough that competitors can't compete, they go out of business. But typically that would be a company that has economies of scale. Like a Walmart, sort of a perfect example there. The concept of Mr. Market is one that's actually from, again, Ben Graham, who was basically Buffett was a big follower of Graham. Graham was really where value investing kind of got its start not too long ago.
Just as a quick side note.
And there's a lot of things from Graham, who wrote the first edition of his book. I don't know if anybody's seen the security analysis book. It's a big, thick one. Wrote in 1934. Read that book if you want to really understand how to value companies, even though it's dated. One of the concepts that Graham talked about, though, is this idea of Mr. Market. And he has this analogy where he says, Mr. Market, he's this manic, depressive guy, and every day you're a partner in business with him. Every day he's going to show up and he's either going to be over the top happy and he's going to offer to sell you his stake in the business back at a price that's too high, or he's going to be very low. He's going to be depressed about something and he's going to give you a dirt cheap price about it. And the point of it is that market prices and the market in general is something that you can either use or ignore as you see fit. The market is a tool in the value investor mind to again, ignore or use as best you see fit. And by using it, I mean take advantage of it. And we'll talk a little bit more about that in a second. But it's just kind of a different approach to think about market prices, and that's a key part of things. Hey, come on in. Another very important part of Buffett's philosophy, again, came right down from Ben Graham, is the whole idea of a margin of safety. And we'll talk margin of safety a little bit more in a second. But this, in Graham's mind, and Buffett later echoed the same idea. Three most important words in investing: margin of safety. What does that mean? It means if you're going to buy shares in an enterprise, that you need to be confident enough in your valuation that should you be wrong, or should the company, should management screw something up, or should the wheels fall off, there's at least enough of a cushion between what the price is and what the real value is that your losses will be disproportionately smaller than they otherwise would be. Does everybody follow me there? Okay, all right. Another way, basically saying, stay away from the growth stocks. No Chinese solar stocks, please. And I think this is one of the last Buffett ideas. The idea of running focused and concentrated portfolios. Now, in the hands, this statement I feel is one of those that can be used for good as well as evil. If you don't know what you're doing and you focus your bets, then odds are it might not end out that well. But if you are confident in your ability to value a company, if you're confident in your ability to think about market prices, then it just doesn't make sense to, in Buffett's own word, how much sense does it really make to put any money into your 75th best investment idea? If you have a fund with 150 companies, well, it's a lot of work. It should be a lot of work, I feel, to even add one to the portfolio and to do 2 weeks worth of work and have it be, you know, 0.5% of the portfolio, there's a practical issue there too. But so the Tarpon, for instance, right now has 15 companies in it, the fund I run. It'll probably shrink over time. If I could get it down to 10, I would be, I'd certainly be less busy, but that's a whole other discussion.